Hello, everybody. It's February 6th, 2018, and Jim and Jen here to do the Happy Hour with Jim recapping the highlights of the volatile market from yesterday. And Jim, hand it over to you.
Jen, thank you very much. We wanted to do kind of an abbreviated version for those that didn't want to, be forced to sit through an hour, because this can be recapped. I'm not an economist, but I have been in the markets for 40 years. I've read a lot and I've seen a lot, and I want to take it from, that point of view. I really approach this from three different views. The first is the short and intermediate term trading inventory. Inventory of short and intermediate term traders is very important in the market. They can move markets, and it can be pretty dramatic at times. Next, I want to talk about the investment manager inventory, or the longer term positions. And then finally, I want to talk about fundamentals. And when I say talk about fundamentals, I'm talking about valuations, price earnings ratios, etc. Looking at a monthly bar will make it easier for us to have an appreciation of what was going on in this market prior to the break. You will see this is the monthly bar. The monthly bar has one time frame higher for 14 months up until the last couple of days. One time framing simply means that the following month did not take out the low of the previous month. So we had an upside breakout. I counted from the upside breakout, and you can just look along and see one time framing. And then you come into January and you see a real spike to the upside. What's interesting, and the reports show in January, that this was a very high, one of the highest inflows of money from the public into mutual funds, ETFs, etc. So finally, after 9 years of the market rallying, the public finally knew they had to be in the market. And of course, that is what helped lead to this big spike to the upside, and kind of set the potential for a break, as the market just got way ahead of itself. When the market's going up like you see, the short-term traders and the day traders, they don't have a lot to contribute. But when we call them a combination of kind of intermediate term traders, and the intermediate term traders, a reason I say intermediate term traders, they're not investment managers. They're not the people that put stocks in portfolios and hold them for long periods of times. This intermediate term trader has a propensity to leverage very highly. So they may be funds at up to $1 billion or so, and they may employ great leverage. And so they are momentum traders, and they get the market, they just stay with the momentum. Now, the very short and day traders, they just consistently pile on to the direction and the momentum in the market. So when you get the money moving higher, there's a lot of piling on, and people just not really thinking about valuation, just going and afraid they're going to miss any kind of market. During this period of time, the longer term investment managers, while a lot of them, were feeling, at least from the talks I've had, were feeling that the market was getting dangerously high, they just took the view that, well, they'll just ride along with it. There used to be a game in Las Vegas, I don't know if it's still there, called Let It Ride. And that's kind of what they do. They let it ride. And if they got out and the market, part of the fear is if they got out and the market went higher, they're going to underperform their competitors. Now, keep in mind, these long-term managers, they seldom keep more than 1% of their money in cash. So if they hit a point where they become sellers in a market, it can be fairly dynamic and it can move the market very, very quickly. So the question then becomes, what was the environment that got us to this, high that we saw in January, and particularly, when it finally got the late spike that took us to the highs? What was going on? The central banks all over the world provided liquidity. They kept short-term rates low. They purchased assets to support longer-term rates. They were purchasing mortgage-backed securities. So, and they did this in considerable size, including, the U.S., everyone around the world. So this contributed, kept rates low. Now, the stated purpose of doing this, at least by our Federal Reserve, was the thought that if assets went higher, stock prices would go higher, the companies would feel better about what was going on, they would put more money into plant and equipment, they'd hire more people, and the individual people would see the market going up, there'd be more jobs, and they would have a very positive attitude. And so, that was the purpose behind it. And it worked. For 9 years, the market's gone higher. During this period of time, the dollar was fairly well controlled. However, about a year ago, 12, 14 months ago, the US dollar started to soften. When the dollar softens, at least on the surface, that is seen as positive for stocks. That makes the US companies more competitive overseas because they have an advantage on better pricing. So we saw the market for the dollar for the last 12 to 14 months going lower. Along with what was going on, we were getting better earnings. A lot of these companies were reporting better earnings. In fact, if I'm not mistaken, I saw a number the other day that 88% of the companies reporting in the fourth quarter, or at least the last quarter of last year, were reporting earnings that were above expectations. So that set for a very positive environment. And you had everybody finding all kind of reasons to buy stocks and take those stocks higher. Now, what happens when they start talking about valuations? The PE rose, or the price earnings multiples rose. When they rose, that takes the valuation of all these securities higher. And the rationalization is, they come up with wonderful rationalizations about the value is really there, stocks aren't overpriced, etc. Well, there's usually an end to that sometime. So then what happened early on during the 9-year rally? Generally speaking, if you got bad news or bad economic news, that was seen as positive. This bad news meant that our Federal Reserve, as well as other central banks around the world, would buy more assets, pump more money, bring more liquidity to the system. And higher stock prices thrive on liquidity. So that was what was going on. Interest rates during this environment kept going lower, making it more attractive for people to put their money into stocks. Warren Buffett was on one day, and I saw him. He said, for some time, he's saying, why would people buy bonds instead of stocks? You were getting 2% yields on bonds. The government's already telling you they're shooting for a 2% inflation. You have to pay taxes on the 2% of the bonds. So to buy bonds, you're actually going to lose money. So the assets they should be invested in, he argued, was stocks. Stocks were very attractive over bonds. So that moved higher, and we started getting good news. And now we're to the point where good news is bad news. You know, that may sound strange to a lot of people, but that's what happens in the markets, because now the last employment report showed, you know, strong job growth, as well as I believe the wage growth was 2.9%. So now everybody's saying, wow, with wage growth that high, maybe we're looking at inflation again. So if we start to look inflation again, that means that the central banks will take interest rates higher, because they know once inflation takes hold, it is very difficult to stop. I've lived through that period. So if rates start to go higher, meaning that, you know, interest rates start to go higher, what can that do? Number one, it makes it, you know, makes the cost of buying things and doing things more expensive. It can slow real estate. It can lead to a higher U.S. dollar, and we just talked about a softer U.S. dollar being positive for stocks, and, you know, a higher dollar, and not always being negative, but, you know, making our goods a little more expensive throughout the world. So the last employment report, people thought, wow, you know, things are pretty hot. Market's pretty good. Employment's pretty good. We're reaching full employment. That could be inflationary. So all of a sudden, interest rates are already rising, but now the vision of this happening even more really starts to come front and center. At the same time, the central banks are taking away liquidity. This liquidity they'd been putting into the market for some time. Now they're, you know, very controlled, but very quietly selling assets in their portfolio and raising both short and long-term interest rates. Well, what occurs then is, and I think what we're seeing right now, is a readjustment of valuations. That PEs, or, you know, price earnings multiples, have a tendency now to move lower. So if PE multiples move lower, or at least that's fundamentally how they see the world, then that, you know, that means that valuation is probably too high at this point. Then investors and money managers, they start lowering their expectations for increase in the value of securities. So then all of a sudden you start to get, you know, this readjustment, and in today's markets, it can take place very quickly. You know, news is quicker, and markets have a tendency to readjust very, very quickly. On top of that, there's a lot of political uncertainty going on, particularly in our country, and, you know, and probably the same thing that we have around the world. So that's what I think is going on. It's just it's a reevaluation of, our stock prices too high. There's some sense that they are, as we talked earlier, for 14 months, the market one time framed higher. Then you had a big upward spike in January. So you can get a feeling that prices just got ahead of themselves and get the valuations too high. And now we're probably going through an adjustment of that process. Now, what normally happens in this period of time? There are two ways to bring this valuation back into line. One is you can have stocks move straight down in a much lower manner, or you can have stocks move lower and then bracket or move sideways for many months. So if in fact the stocks move sideways in what we call a bracketing or trading market for say a year, well, guess what? That gives the PEs and other valuations a chance to catch up, because as earnings go higher, the stocks aren't going higher, so that allows things to come back into balance. Now, I don't know if that is what will happen, but what normally happens is we go bull to trading range to bear or bull to trading range back to bull. It is very rare that we go directly from a bull market to a bear market. What we're seeing, the break we're seeing in the market right now, kind of a straight down break, can set up the left-hand side of a bracket, and you may be in that bracket for some period of time. I hope this has been of some value. And just so you know, we've got the training courses or the educational courses underway right now. But I want you to know that we do, while we're traders, but we don't trade in a vacuum. We are aware of other things that are taking place in the market. And again, we then try and structure our education and our shorter term trading relative to what we see in the bigger picture in the market. Anyhow, let me say thank you very much for listening to this recap, and we hope that you take a look at the specials that we're currently offering. We call them Valentine Day specials, and they go through Valentine's Day, a better pricing for everyone. Anyhow, once again, thank you all very much for listening.
Oh, great, Jim. Can you show the next slide? It'll, for anybody who is not familiar yet, you're going to get daily webinars, and all of them are recorded in case you're not able to attend a session and you'd like to view them later. You'll get the 2 daily reports, one in the morning and one in the evening, and Jim's live commentary throughout the day, for which now you also have the option to hook that up with the private Twitter account if you'd like to get those messages on your mobile phone. There will be question and answer sessions, a daily synopsis video recap, which is a time-lapse video with Jim's observations and comments pointed out, and you can also see how the day develops with the market profile, and as well as other webinar sessions that we'll add as needed. Currently, we have over 61 hours of webinars scheduled for course 1 alone. So that's just to let you guys be aware of how much time we're going to be spending with you, and all the different things that will be covered is also in the course description. If you go to our website and go to the course description, the view details, there is a tentative schedule posted there for session 1. Thank you very much, and we hope you guys enjoyed this video. Thank you very much.